Hello and welcome back to All Things Money. I'm your host, David Blain. As we get into the final segment here today, we're talking about investor sentiment and the uses for it and uses that I wouldn't recommend. So we're just talking about how what I'm talking about here is not designed. I don't want you to go run out and try to get in and get out of the market. It's really not possible to do on a reliable basis over any sort of length of time and to on an after-tax, after-fee basis to come out ahead. But in the short term, number one, it gives you some indication of what's going on out there, gives you a comfort feel, and if you're trying to determine whether to put new money in or something like that, there's nothing wrong with making small decisions based on this information. But we use it mostly to help people understand what's going on and to show the cyclical nature of people's fear and greed. So anyway, I talked about Ned Davis Research, a service that we use to help gauge this investor sentiment. And it's fairly reliable that when you see the indicator get above 70 on a scale of 0 to 100, at some point, once again, you can't time it, but at some point in the next several months, the market usually takes a pretty decent nosedive for a while. And then when it gets down below 30, you can pretty much expect that very soon thereafter, the market's going to take an upswing. And you look at this, if you, Ned Davis has built indicators to time this, and when you look at it, there's such a small differential that, after tax and fees, that there's no way that you're going to come out ahead. Plus, it's not always accurate. Sometimes it's not correct at all. But anyway, so that's not available to individual investors. So I was doing some research the other day, and I came across something on a website that, I can't believe I'm actually going to talk about this because it's on CNN.com. And I'm not a big fan of CNN. I think their news is, when they started, it was okay. It's pretty much awful now. It's almost tabloid-like if you ever log on to the homepage. I mean, it's visually assaulting. It reminds me of a, TMZ type thing these days. Anyway. One thing that they do have that I still can't believe that they have this. They have what's called a fear and greed index. And if you just type in CNN fear and greed index, it'll bring up this nice looking speedometer. And this thing is very good. It has some of the similar indicators to what Ned Davis uses in his. But anyway, so as I pulled it up this morning, on a scale of 0 to 100, the fear index was at 10. 10. So that indicates extreme fear, that people out there are extremely fearful. If we look at this indicator, and it's still in beta, but they have some back-tested data. If we look at it back to 2011, we see the debt crisis. We see that people had extreme fear then. And then back in 2012, the Euro crisis, when, of course, Europe was going to fall off the face of the earth and the euro was going to collapse, we see that indicator drop down below 20. But anyway, it's a great little speedometer for those of you that maybe could see it on TV. But so it gives you an indication of, is there a lot of fear, is a lot of greed. And the idea investing is to use something like this and do the opposite. So for example, let's say you've been sitting on a bunch of money in your money market account and you're not sure what to do. We would recommend just putting that money to work. But something like this indicates when there's massive fear running through the market is generally a good time to invest. That's right out of Warren Buffett. Invest when others are fearful and be fearful when others are greedy. So some of the components that go into this are, number one is market momentum. How far has the market got above its, and for this they use a 125-day moving average. So if the moving average is going this way and the market price is going up much faster than the moving average, and that difference between the two, if that gets too broad, that shows a lot of over-optimism in the market. The same thing, if it drops way below that, shows a lot of fear in the market. They also look at indicators such as junk bond demand, which is simply the spread between what we call junk bonds and higher quality bonds. As that demand for junk bonds increases the spread between investment grade bonds and junk bonds. As it compresses, then you see people becoming more fearful. We also see indicators here such as market volatility, which is the VIX, the VIX, which shows just the volatility of the market. And typically you see high market volatility spiking up when people get fearful. It's very low. People become very complacent at times when they have high confidence in the market. Some of the other indicators, what we call safe haven demand, and this is just simply taking the difference between stocks and bonds, looking at the difference in returns in those two. Historically, the returns of stocks have been higher than bonds, and yes, there are some time periods when that is not the case. But in general, if you believe that capitalism works, if you believe that markets function at all, that over time you would accept that stocks would return more than bonds. And so you look at the differential between the two to determine if people are being fearful or greedy. Put call options. I don't want to get into a whole bunch on options right now, maybe for another show, but buying options, which gives you the right to buy or sell a stock or index, have things called put and calls. And suffice to say that when you have a lot of people selling puts, people are very bearish. When you have people buying calls, people are very bullish. And so you take the difference between those, it's called the put-call ratio. And it's a good indicator to see whether people are fearful or optimistic. We also look at something called stock price breadth. And that looks at the volume on the stock exchange of companies that went up in value versus those that went down. So for example, if the market went down on a day, but there wasn't a lot of volume, not a lot of trading in the companies that went down, well, that's not so bad. But if the market goes down and you see huge spikes in volume in those companies, that's a little bit worse sign. Well, anyway, so we're running out of time here, but that's the CNN Fear and Greed Index. It might be a little useful tool for free that you all can look at home. Well, that's about all the time we have for today's show. I hope you enjoyed it and that you'll join us again next week. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.